there you have it, the closing bell at the New York Stock Exchange. The markets slid Wednesday mainly due to the continued violence in Ukraine and higher energy prices. The Dow dropped about 70 points.
The S&P 500 closed in the red after dropping close to 1%. And the tech-heavy NASDAQ also suffered some losses, falling more than 1%.
Joining us now for more on this is Brent Schutte. He's the chief investment strategist of Northwestern Mutual Wealth Management Company. Brent, welcome. Great to have you with us. So
Thanks for having me.
The yield curve briefly inverted on Tuesday for the first time since 2019, triggering concerns over a possible recession. Explain to our viewers who don't know or may have forgotten what exactly the yield curve is and why it's worrying.
Sure. So the yield curve is essentially all the different bond maturities that go out from 1 year, or actually 3 months, out to 30 years. And so the one that people watch the most is the 10 minus the 2-year Treasury. And normally it's positively sloped. So if you buy a longer bond, you want more compensation than if you buy a shorter term bond for all the uncertainties. What happens before recessions typically is that the 10-year yield will yield less than the 2-year. And that is signaling a gross slowdown of potential recession. And you saw that briefly happen yesterday, which stoked some worries. But I would take it with a grain of salt. This is far from a perfect economic indicator. It has had false positives in the past. There usually is a long and variable time before the next recession. So it can be 12 to 24 to even 36 or more months before that recession happens. And importantly, other yield curves, which have preceded also other times of recessions, like the 10 minus the 3-month, is still positive 1.82%. And so that one has a long ways to go, which tells me that we could have a recession at some point in the future, but it's probably pretty far off. And usually between now and when that recession occurs, the market does very well. And so I would take it with a grain of salt and look to the other parts of the economy, which are still strong.
Brent, how's the expectation that the Federal Reserve will continue boosting interest rates, impacting, one, consumer confidence, and two, investors' strategies?
The big fear here is that the Federal Reserve will miscalculate and over-tighten the U.S. economy into a recession. And so that's the fear that's out there because inflation has become a bit more permanent than what I think most people thought. The good news is I do think inflation will roll over as you push towards the end of the year. And so if you think about consumer confidence pulling back, that means demand will likely pull back, which hopefully will allow supply to catch up. And that's been where the big imbalance has been. You've had this huge amount of demand coming out of COVID against a backdrop of supply chain snarls, especially on the goods side. That will hopefully continue to alleviate as we push towards the year, and that will allow inflation to roll over, which to me, I think people need to go back to what the Fed's goal is. The Fed is not looking to tighten the U.S. economy into submission. That is not what they want to do. What they are trying to do is to try to raise rates enough to fine-tune the U.S. economy to get the cycle to be longer. And they are going to err on the side of too little, not too much, unless they are absolutely pushed to do so. And right now, I don't believe they're in a position where they have to tighten rates as much as, say, back in the 80s when Paul Volcker had to convince the world that the U.S. was serious about fighting inflation and he intentionally caused a recession. We are nowhere near that. The market does not believe that inflation is permanent, despite all the news that is out there that it is.
All right, let me ask you about the labor market, Brent, because as you know, it's tight and continual jobless claims are down to their lowest level in decades. And so now we're seeing workers taking advantage of the odds being in their favor. More than 4 million Americans opted to leave their jobs or opt out of the workforce last month. How long do you see this trend continuing?
I think it's already actually reversing. I think you'll see further evidence of that on Friday. So there's a separate report than the establishment report, which kind of is reported on Friday. It's called the Household Employment Report. And it's shown the past few months that about 1.7 million workers in the United States have re-entered the labor markets. And so if you think back, we had those pandemic unemployment benefits that expired in September of last year. You also had COVID hopefully continuing to recede. And what you're gradually starting to see is that workers are finding their way back into the labor market, which is key to keep the cycle going. I mean, we have 11.6 million jobs that are available right now, and only about 3 million more people, based upon my calculations, to get back to where we were in 2020. And so the question is going to be, can we draw more people back into the labor force? Hopefully wages will do some of that, and that will actually be a way to keep the cycle going. I'd also note that the workers that we have are becoming more productive, which is a key concept. And so if we don't have as many workers, can we make them more productive? And you've seen positive data on that front recently.
Brent Schutte, thank you for your expertise.
Thanks, Brent.
Thank you.